Hey everyone, welcome back to Policy Punchline. Here at the show, we interview scholars, policymakers, and business executives about some of the most urgent issues and frontier ideas in our world today. I'm Princeton senior Tiger Gao. My guest today is Peter Wendell, who is the founder of Sierra Ventures, a Silicon Valley venture capital firm that has invested more than $2 billion over the past 35 years in a wide variety of successful technology companies. Peter has taught more than 2,000 Stanford MBAs over the past 30 years, specifically the very popular course, Entrepreneurship and Venture Capital, co-taught with Google CEO Eric Schmidt and Scott Kupor, who is a managing partner of Andreessen Horowitz, another very big venture firm. Peter serves on the board of Merck. He also just completed his trusteeship at Princeton University. He was also, for 6 years, the chairman of the board for Princeton University Endowment Company, which oversees Princeton's endowment. And during his 6 years of tenure of the chairmanship, PRINCO doubled Princeton's endowment. Peter has been recognized by Forbes magazine as one of the 100 best technology venture investors in the United States, and named one of the 15 venture capitalists on Upside magazine's elite 100 list of influential US leaders in technology, finance, and business. We're very honored to have you here, Peter. Thank you so much for joining us today.
Great to be with you, Tiger. This will be fun.
So maybe we can start just by talking about what venture capital is, what you do, who you are. So who is Peter Wendell, and what got you into venture capital?
Yeah, thanks, Tiger. I went to Princeton like you did and graduated in 1972. I was lucky at Princeton to be fully supported by the university. Total scholarship student. My family was from no economic means, but I was quite interested in economics and in investing. Right out of school, I went to work for IBM, which was kind of the technology darling of its day. Hard to think of that back in the early 70s. And I learned a lot at IBM about technology, mainly about how businesses use technology. So about 8 or 10 years, I had 2 years off from IBM for good behavior to go to business school. And then after I came back to IBM, I was approached by some wealthy families to help them deploy some of their capital into the early startups of the day. Sierra Ventures started in the early 80s. Apple Computer had just gone public. Genentech in the life sciences had just gone public. And a lot of people perceived the great opportunities that lie ahead in funding technology-oriented businesses. So this family, who actually was a Princeton family, Lewis Marks, approached me and asked if I would be interested in investing some of their money in the venture business. And frankly, at the time, I never would have given any money to me. Okay, I was some IBM guy who knew a bit, but not very much. But it was a great chance to start a fund. The venture capital industry was tiny then. In the U.S. in the early 80s, the venture capital industry was deploying $3 or $4 billion a year. For reference, last year, the venture capital industry in the U.S. deployed about $160 billion. So many times smaller. But it was a great chance to start to work with early stage companies and learn how to build value, particularly when things went right. So, I moved to California. In fact, I'm sitting today up in the wine country. That's not Silicon Valley behind us. That's the Dry Creek Valley, which is a wine growing region north of San Francisco.
Almost looks like a Zoom background, but it's the
yeah, no,
background.
it's exactly. Real. It's not a background. Yeah. But I hope we don't have too many airplanes overhead or construction projects down the mountain. But more than you want to know about how things got started. So a very traditional career with IBM, and then jumped off to start a venture firm, probably one of the highest risk things I ever did.
But just at the right time. They bet on you and bet right hugely. I suppose that
Well,
was
yeah,
just the.
it's worked out. It's worked out fine. Sierra Ventures is now, almost 40 years old. The way things work in the venture business is you raise a pool of capital, you invest it. Hopefully, there's proceeds, and you distribute those back to the investors, and then you raise another fund of capital. So, about every 3 or 4 years, you raise a fresh fund of capital. Typically, those are Roman numeral funds. So, when the first one was Sierra Ventures, we didn't know to call it Sierra 1. We weren't that optimistic, but actually there was a Sierra 2, 3, and most recently Sierra Ventures Fund 12 was raised. I worked for about 30 years as an active investor at Sierra, and the second generation of the firm is moved forward. They let me hang out there and use the email address, but generally the younger team there has been taking forward the newer funds. Sierra 10, 11, and 12 are funds that I'm not an active investor from.
So how does the VC industry actually work? I suppose many people have heard about this. I mean, we read a lot about what's happening in Silicon Valley. The industry has obviously grown very big. But I guess just to sketch things from an insider's perspective over your years, how have you seen the VC industry evolve? How does it actually work?
Yeah, well, at the highest level, Tiger, it's pretty straightforward. The venture capitalist, she or he is the party in the middle, and the inflow of funds to the venture capitalist comes from typically institutional investors that invest in the venture industry, the large endowments like the Stanford Endowment, the Princeton Endowment, large foundations, Ford Foundation, Hewlett Foundation. So all this institutional capital comes into the venture business, and then the venture capitalists, they're the party in the middle, and they're kind of a big opportunity sorting function. A good venture firm has lots of possible places to invest their money. They have lots of different entrepreneurs. And what the venture capitalist in the middle of the transaction, he or she is sorting those opportunities and rationing the capital. Who gets capital and who doesn't? Whose idea is going to get $20 million dumped on it to flourish? And who are we going to leave in the waiting room and not fund? So those are very important decisions. It's a very different than most types of investing, like in the stock market. If you go on Robinhood and you buy a stock in the morning, you can sell it in the afternoon and you either made money or you lost money. The venture capital industry is a slow ooze, all right, from the time for the typical venture-backed deal, from the time the first venture capitalist writes a check to that company to the time the first liquidity is received by the venture community is typically about 7 or 8 years. So, for venture capitalists, it takes a long time to get feedback. Imagine if you were a student at Princeton, you handed in a paper and the professor said, yeah, I'll give it back to you in 10 years with your grade. Wow, that's half my life. So it's a very long time horizon sort of investment. And just to
quickly interject in that part, how do you hone your skills, your company evaluation skills, your intuition, when you have such a long feedback loop? You could have invested in something you don't even know if your bets turn out to be right or wrong in 8 years.
Great question, because like you could be dead. It's like the Nobel Prize. You get it 20 years after your work.
Exactly.
But that's why the concept of a venture firm is important, because it's kind of an apprenticeship business. You can hang out your shingle and say you're a venture capitalist, but there's a long learning curve. So if you work in a firm like at Sierra Ventures, the firm's been around 35 years. There's a lot of collective wisdom. So some new person joins Sierra Ventures, he or she is going to get a sense from those that came before them. But you're very right that the feedback loop is complicated by a number of things. It's not just the long elapsed time. The judgments you're trying to make, you're trying to invest at an appropriate value. So you're trying to buy smart, but if you're not going to be getting liquid for like 8 years, like you don't know what the capital markets are you're going to be selling into. So how should you value the exit? You don't know, is the market going to be in a trough or a peak or what's going on? And you don't know what other technology waves are coming. You could invest in something that's a cat's meow now, and 6 years later, it's a turtle on its back, So it's really hard to get feedback. There's a lot of instinct and intuition, particularly in early stage venture investing. I'm sure some of your listeners have gone to business school. They know what a Harvard Business School case study looks like. Well, when a venture capitalist comes on something, it's like a Harvard Business School case study with all the exhibits ripped out. There are no numbers. There are hopes and dreams and some entrepreneur waving his arms frantically about how great it's going to be. But you're really making instinctive judgments, to your point, that are going to have long feedback loops and going to ultimately get liquid in an environment that you have little clue of what that environment is. So good luck making money in the venture business.
Peter, you were just talking about how VC investors are really taking risk in entrepreneurs, but it does seem that the industry has really ballooned since the early 80s or 90s when you started. It does seem that there are more capital than good entrepreneurs right now. I mean, I was talking to one of my friends who started a fintech company and is going to like YC, and he's talking that like people are overflowing him with money, like higher rounds. So how do you think about the current VC industry, the environment, all that stuff?
Well, you're certainly right that there's an awful lot of money available. I mentioned earlier that last year there was about $160 billion of new U.S. domestic venture rounds. I compared that to the earlier days of Sierra Ventures, 3 or 4 billion a year. And hey, there's certainly more entrepreneurs now too, but the U.S. and the world more generally is awash with risk capital. And the other implication of that, Tiger, is that it's changed the dynamic between the entrepreneur and the venture capitalist. It used to be that the venture capitalist had a lot more power in that relationship, right? Because there wasn't a lot of capital. And when the venture capitalists were rationing the capital, as I described in the beginning, there wasn't so much to give out. Now there's a ton of capital to give out, and the entrepreneurs pick which venture capitalists they want to take it from. So it's really changed the dynamic, giving the entrepreneur a lot more power. It's a great time to start a company.
Maybe we can talk a little bit more about the relationship between entrepreneurs and venture firms. You gave a talk at the Griswold Center at Princeton just a couple months ago, and you were saying how entrepreneurs really need to make the venture capitalist investors have enough greed to overcome their fear. So they're actually incentivized to make this highly risky investment. How does this greed FOMO work, the fear of missing out, work in VC world?
Yeah, well, for a venture capitalist, they're dealing with a portfolio of companies. So a typical venture fund, I was talking earlier about Roman numeral funds, a typical venture fund might have 30 or 40 investments in it. And you know what? 80% of those really aren't going to matter, right? Like less than 20% of the deals are going to produce virtually all the profit in the portfolio. And that's true in good times or bad times. But, it's like baseball. It's about a slugging average, not a batting average. And if you get a couple of home runs, it changes the whole score of the game. And it's funny, in good times or bad times, it works out that way. It's because in good times, a huge hit occurs and the venture firm makes so much money on that single investment that not much else that they did for 3 or 4 years really mattered, Now my wife tells me, Tiger, just do those deals and come home every night at 5 o'clock and we'll have a nice elongated dinner, But unfortunately, given the sort of feedback loop where you don't know for years if you even did it.
To wait for 7 years for the wine to come.
Yeah, exactly. But anyway, so on the dynamic, you were asking about the dynamic and the venture capitalist's greed overcoming his or her fear. Yeah. And I don't want to paint venture capitalists as horrible, greedy people, but I use greed in an economic sense, because if you're building a portfolio of investments, Sierra Ventures Fund 5, you're building a portfolio of investments. Sierra Ventures Fund 5 was a long time ago. It had about 22 investments in it. And, 4 of the investments returned more than 3 times the total amount of capital in that fund. So some of the other ones were all right, but they just don't matter. So if you're the venture capitalist, all you're doing is this entrepreneur is sitting across from you and you're saying, is he or she bringing me the big one? Is this the black swan? Is this one of the real future unicorns that I don't want to miss out of? Venture capitalists fund bad things all the time. I just got done saying that 50, 70% of the deals never amount to much. That's not a sin in the venture world, funding something bad. That's the risk reward profile of the asset category. What's bad is missing the big one. You had Jeff Bezos sitting in your conference room pitching this book company, and you said, oh, this guy's kind of nerdy. I don't think, next. And like, holy mackerel, 10 years from now, you're saying, I missed Amazon, right? So it's that fear of missing out. You get those juices going in a venture capitalist, he or she's likely to write you a check.
So we had Austin Allred, who is the founder of a firm called Lambda School, on the show a couple months ago, and he was telling us he was part of the Y Combinator program, the very famous incubator, and he was saying how we were asking him this kind of question, whether this FOMO, and he was saying how YC had like a maybe 7% stake in Stripe, and Stripe is this company that's like valued $100 billion very recently. He said that's like a 7 billion kind of return. So he said there's no way that YC has ever, invested $7 billion. So the fact that you have one of those, and certainly YC has other very successful companies like Coinbase and so on. So you just need one investment, and that kind of saves everything. But that also seems to be generating an interesting dynamic, because if I'm a partner at Sequoia and I had a call with some kid in some college, and there's another fund from Benchmark, that partner doesn't want to miss out, and he wants to hop on the call as well. So everybody kind of piles on. So it just seems that right now, especially with low interest rate, it's so easy to just write a check, right? Everybody just want to get the check out, immediately. So do you feel like we're entering a cycle where so much money, the due diligence process becomes much quicker, and the FOMO is driving the investments more than anything?
Well, the short answer is there's a lot of data to support that point of view. And specifically, although last year was a very active and big year in the venture capital industry, a lot of the money was being invested in somewhat later rounds. And by a round, I mean an entrepreneurial company that's in relationship with venture capitalists. The venture capitalists don't write one check and then they're done with the company forever. Venture capitalists usually provide enough capital to fund the company maybe for a year or two. And then there's another round. The rounds are usually designated by letters. So there's Series A, Series B, Series C. The average venture company that gets past the second round, that doesn't just hang around for a year or two and then die. But the average company that goes the distance would have about 7 rounds of capital before it reaches a liquidity event. So for the venture capitalists, there's 7 times that they kind of re-underwrite how they feel about that company. And normally, Tiger, in each new round, the existing venture capitalists usually have one new firm come in because that new firm kind of prices the deal, right? Because they're a virgin. They don't have any horse in the race. So the first interesting thing is who gets the phone call to be the new investor, right? Because venture capital is a competitive industry. Venture firms compete with each other, but it's also an industry with a lot of collusion and a lot of syndication. So it's both a competitive industry and a collusive industry. I mean, think of it like the insurance industry. Insurers compete to write insurance for this or that, but insurers also form reinsurance syndicates, right? So it's the same thing structurally. But what's gone on most recently, last year in the venture industry, is the majority of the capital now isn't going to new ideas. It's not going to some entrepreneur walking into the conference room for the first time and getting venture capital, but it's going to the C rounds and the D rounds and the E rounds, where it looks like, you mentioned Stripe. Stripe's still a private company. You know, Stripe has not gone public yet. I think it's on the G round. I don't know, but it's far along. But that's a great example. Stripe attracted tons of venture capital last year, but it's already a company that's 7 or 8 years along, has a clear franchise, looks like a winner. So the FOMO is high, right? Because Stripe's going to be the biggest IPO since Google or blah, blah, blah. So, so there's all this later stage capital piling in. Ever since Sarbanes-Oxley, most entrepreneurs are in no rush to go public. They're just as soon say private. All right, we'll have the G round now, we'll have the F round next year. They're getting increasing valuations. But the most interesting part of the venture business is the first round, the initial decision to invest. And those are getting somewhat squeezed out because so much of the money is being funneled into about 50 or 60 later stage companies who are still private. And so it's a different dynamic. And those are very competitive rounds to get in there. And because they're so competitive, that's why the price gets bid up.
There's so much to unpack there. Even if we take the Stripe example, I mean, Stripe in some way, they have no incentive to really have to go public. I mean, sure, you're not, you're on paper, you could be on paper, be billionaires if you go public and so on. But, these guys already have all their connections or all the resources they need to develop a company anyways. And as you said, more and more late stage capital just pile in, those growth equity investors. So do you think this crowding out effect is crowding out the actual early stage capital that needs to be devoted to more early stage companies?
Well, the phenomenon I described is taking place on an ever rising slope of more venture capital overall. So if last year the industry hit another record, 160 billion out the door, and even if something like 110 billion of that went to the Stripes of the world, Databricks, companies like that, that still leaves a much bigger slug of capital for the real early stage, higher risk, higher reward things. So crowding out is maybe not the best word choice I used. It's more that the dynamics of the industry are shifting, and the imprimatur of a great venture firm investing in you, Sequoia says, oh yeah, we're in every round of this, or Andreessen Horowitz, or some of the more visible firms, that then the Tiger Globals want to come into that. These people who aren't even venture capital, I mean, they're hedge fund guys.
We should really talk about them. I mean, Cotu,
so there's
Tiger Global. Yeah, these hedge funds, they've been so aggressive in preempting the good tech companies. They move very quickly through diligence process. They pump up the valuation. They just give you cash, right? And they seem to have changed the game.
Well, they have. We'll see. About 15 years ago, Josh Lerner and Paul Gompers, two professors at Harvard Business School, wrote a book about the venture capital cycle. And it was how historically more and more money piles into the venture industry. Finally, returns start to diminish. And then the interest in the industry from the institutional investors goes down. But then, when there's more of a scarcity of capital, returns improve. And,
Like
Tiger, all financial markets are cyclical. Okay.
Yeah.
Virtually all financial markets across all asset. The venture capital markets are no exception. But one of the things that that Lerner and Gompers offer in this book is some pretty good evidence that because of some of the factors we spoke about earlier in the interview, that the feedback loop is so slow and sticky in the venture industry that investors don't get it. The money keeps pouring in long after the punch bowl left, and therefore the cyclicality isn't as efficient. It's not like, if you're trading a high cap, you're trading General Motors stock, or you're trading Merck stock, that's a very efficient supply and demand sort of market. But venture capital, the cycles aren't as efficient. And so there's a lot of overshooting in both directions. At least this is what Gompers argues in his Josh Lerner and Paul Gompers argue. They've recently come out with a new updated edition of their book. You can find it online. I think it's the MIT Press published it, but it's called The Venture Capital Cycle. It's exactly what you were talking about.
So do you think we're nearing a more of an overshooting stage where it's more of a bubble? I mean, there are some structural reasons.
It's hard to imagine. It's hard to imagine that we're not. Okay. I mean, if you just look at the multiples and the valuation metrics, it would be hard to say that, boy, no, we're very constrained. This is going to continue straight up and to the right for the next 10 years. There's no stopping it. I don't think that's where we are.
What would a VC winter look like? Because you also previously mentioned in your Griswold Center talk that a lot of the institutional investors, the limited partners, the LPs, such as the Princeton Endowment, they are capable of driving the cyclicality in this industry because they can together come in with all their capital, where they pull out of their capital, and so on. So what would a VC winter look like?
Well, first of all, it's not a sudden storm. As I was saying before, it's more an ooze, right? Because it's remember when an institution makes a commitment to a venture firm, that's a 10-year commitment, like a venture fund, Sierra Ventures 5. That fund goes on for 10 years. The limited partners capital is tied up for 10 years. 10 years. So even if every big endowment and every big foundation were listening in on our conversations when I said, "Oh, holy mackerel, did you hear that Tiger and that Wendell guy talking like, we better stop doing venture capital." It would take years before the valve finally shut, and the valve would just get shut because there's so much forward commitment. The valve would just get shut in time for returns to start peaking up again. So, and again, this is a bit of what Lerner and Gompers argue in their book, that the cycles are somewhat more smooth. But a good example of this would be after the tech bubble burst in 2000 and 2001. In 2000, the amount of limited partner capital, fresh capital being committed to the industry was in the range of $100 billion. And by 2002, the amount of new limited partner capital committed to the venture industry was $6 billion. All right, so from 100 billion to 6 billion, that will eventually ripple through. Okay, but again, once they make a commitment, the commitment is oozed in over 5 years or so. So it's not like the whole tech world stopped for 5 years, but when the forward commitments, your forward commitments are less, then the VCs are going to be more constrained in their behavior.
So it sounds like you cannot time the cycle. I mean, simply because the cycles are by definition, by construction, much longer. But shouldn't investors be somewhat worry about this? Say I'm Princeton Endowment, I could say we seem to be on an upward trend, and I kind of feel like, in a couple of years the bubble may pop, and maybe now is not the good time we invest in. But after the bubble pop, it sounds like in 2002, it should actually be the great time to step in, because that is when the cycle will kick back up again.
It's easy to do these things in hindsight. And, it's interesting. If you look at, and these numbers are public, so I can talk about them. At the time of the last huge bubble in 2000, if you look at the Princeton Endowment, they work on a June 30th fiscal year. And I won't remember this perfectly, but I'll be quite close. For the year ending June 30th, 2000, the Princeton Endowment had an overall 12-month return of about 32 or 33%, which is pretty good for moving billions of dollars, 33% a year. But the way they got that is the sliver of the endowment that was invested in venture capital for those 12 months actually returned 202%. And all the other stuff, the other 90% of the endowment, had its normal kind of 8 or 9% return. And you do the math on that, and you come out with an overall return of, 30, 35%. So there you are, proudly reporting on the steps of Nassau Hall that you've had a 35% return in your endowment, largely because the venture industry really powered you. But you know what? I think it's at a peak, and we're not doing any venture investing for the next 5 years. Like everyone would say, wait a minute, what is that? You're killing the goose that's laying the golden eggs. So it's hard emotionally to back off from something just at the moment you should. And then if you don't invest for 4 or 5 years, then you're going to have no venture capital, new vintage in your portfolio for 5 years. You have to hold your nose and stay. And the venture room, you were an investor in Andreessen Horowitz Fund 2, Fund 3, and then you thought the world was too overpriced, so you didn't show up for a fund. You think they're going to let you back in their fund? When they,
by the way, they're very exclusive regarding who can come in, because the top VC investors, it's very hard to get into a fund, to get allocation into these funds.
Yeah, and the reason it's so hard is because different than if you look in the U.S. at public stock investors, and you take the top 100 public stock investors, the difference between number 1 and number 100 is pretty tight. Maybe it's 200 basis points, 300 basis points. But if you take the top 100 venture investors in the U.S., there's a huge dispersion. It's about 3 or 4x the dispersion. So the value of being in the top quartile venture fund is hugely high compared to the value of being in the top quartile public investor, because the dispersion much broader. So what does that mean? It means if you're a top quartile venture fund, instead of keeping 20% of the profits for you, the so-called carried interest, you probably keep 30%. And instead of charging a 2% management fee, maybe you charge a 3% management fee, because your returns are so outsized that you can tax them in that way. And the net return to the endowment of the foundation is still much better than what they're going to get if they're in some third-tier venture fund. So that's why there's such preening by the institutional investors to get into certain venture funds.
So we've been talking about cycles for a bit, and I'm not asking you to try to time the cycle, but I would love to hear your thoughts on where we are today, because there are people who say, after the year of COVID, we saw this big, tech boom. The tech stocks are up, 100%, 200%. There are people who say we're at a very late stage of a cycle and it's a bubble. And there are also people who say, well, if after COVID, we're entering another great stage of innovation and growth. So this is kicking off another great period of secular growth. So if you look at 5 years out, 10 years out, these companies are overvalued now, but they won't be in 5, 10 years. So this is actually a great time to get in. So which side of the argument do you kind of try to lean on? Where do you think we're at right now?
Yeah, well, I would be on the more skeptical side of that argument. I mean, look at last year, the NASDAQ for the calendar year 2021, the NASDAQ was up about what, 41%, 42%?
S&P 500 is like up.
Yeah, well, but the
42%,
NASDAQ outperformed the S&P by quite a bit last year. But the S&P was, well in the double digits.
Yes.
But just take the NASDAQ, because that's the tech laden. You were asking about tech and the tech bubble. So how many years can the NASDAQ grow at 40% a year? Like, hey, that's not happening. I'm 71 years old. I've seen this movie many times. Trust me, the NASDAQ is not going to grow at 40% a year for the next 10 years. Not happening. And yes, I think you are right that there is a good climate for innovation right now. And, the economy is snapping back. But, during the pandemic, the venture industry didn't go on vacation. There was about a 3-month period near the beginning of the pandemic where venture activity slowed. But I gave some full year numbers before, and the numbers for the first quarter of this year are equally robust. We're still in the second quarter, so I haven't seen the numbers for that yet. But, on the snapback theory, that implies you're snapping back from something, but there was never a big contraction that we're now snapping back from, is all I'm saying. That the venture capital industry is by and large motored right along during the pandemic. There was about 90 days in the very beginning where everyone was scratching their head. But I do think there'll be a lot of opportunity, but how much money can you make on it? Because it's a supply-demand dynamic in capital provision. And if there's so much capital washing in and you're paying such high valuations, and only a third of this is going to work anyway, so that third that works has to really work to cover the 2/3 of the sins that you never should have done in the first place. So I'm not thinking more robust return days are ahead. I'm thinking the opposite.
So how should we interpret this current situation, especially for maybe a retail investor and individual investors? There's this whole SPAC boom, special purpose acquisition companies, and that whole narrative was that we are finally exposing the Main Street investors, the mom and pops in the Midwest, the opportunity to invest in emerging tech companies, because for decades they've been told to just put their money in Vanguard, but now you can get into on a train of electric vehicles or nuclear energy or something. So
democratizing.
Yeah, exactly. Yes.
Yes.
Yeah, people are even talking about breaking off LP units of venture funds or something, and you
packaging them up like a security, and
exactly
Wall Street can securitize anything.
Yes.
Tiger, you might be taken public.
We're trying to take this podcast public. I was wondering if you would like to.
Just so I get my founder's shares, it's okay.
Take part in this.
But
yes.
That part of the SPAC narrative, and for your listeners, most of them understand that's a special purpose acquisition company, SPAC, and it's basically a blank check of capital that's raised by a promoter in a public stock. So I'm a promoter, and the promoters, some of them have been financial people, some of them have been athletes, anyone who's got
Colin Kaepernick and athletes.
I mean, we can have Tiger Gow's SPAC. I mean, you can raise the SPAC. So because you got a big following on your podcast, so you raise $100 million, but there's no company. There's no, I mean, you're a nice guy, Tiger, but there's no operating company. There's no revenue. There's no expense. There's no profit. All those conventional little things that actually drive the economy. None of that's there in the beginning with the SPAC. So then the promoter of the SPAC goes out and finds an operating company and buys the operating company into the SPAC. helping himself or herself, the SPAC promoter helps themselves to 10 or 20% of the economics for their trouble. And so let's say they buy a company that was venture backed. Meanwhile, the venture capitalist, he or she's helped themselves to part of the profits and their carried interest, their management fee. This, by the time the poor public person put their money in the SPAC, this is a pretty promoted, skimmed off the top, and they have no idea what they're investing in. They put it in a blank pool, and then the SPAC has to make an investment within 2 or 3 years, or they got to give all the money back. So you have right now, you got 100 or more SPACs out there that are a year and a half old and have made no investment. The watch is ticking. They got to make an investment in the next 6 or 7 months, and then they got to make an investment in 1 month, or it's all over. They got to give all the money back. What quality, what sort of wonderful investment do you think they're going to turn up when there's 20 minutes left, right? It's like if you have a term paper due and you wait until the last day of the term to write it, it might not be A+ work. Okay, so I don't think this is going to end super well. And when the SPAC tucks in an operating company, they put all promotional data out. There's no rules. It's like with the SEC, when you go public, you can't make random 10-year forecasts of what you think you can do. But here, once you're a SPAC, you're already public. So the process isn't regulated by the SEC, at least not yet. But the SEC's made a lot of rumblings here, particularly in the last couple of months. So I think the SPAC process is good because it does give Main Street a chance to get in on early stage deals. But I'm not sure a SPAC portfolio is going to be any better than the venture portfolio, in that some of these will work out really well, but a lot of them won't. And for SPAC investors, most of them don't have a portfolio of SPACs where they're investing in 20 SPACs and they realize 2 or 3 are going to be great home runs and 8 or 9 are going to lose all their money. It's just the majority of people are going to be in things that don't have a happy outcome. Just my opinion.
So Peter, I guess the greater question here, we've been talking about SPACs, and at the beginning of the interview, you also mentioned something that's a great time to be an entrepreneur. Do you think that because the access of liquidity to capital has become much easier because there's so much capital flowing around, do you think it's a good time for flourishment of human potential in this age? Because if you're an entrepreneur, if you're some nuclear power project that was previously unfunded, now there's so much cheap capital that can fund you. So many people say, if you look at the dot-com bubble, sure, a lot of people lost money, but that was the age that ushered in some great innovations. And if the underlying thing that you're funding is some technological innovations, we can solve climate change, with this kind of frothy capital.
Yeah, and yes, that's part of why I say I think it's a great time to start a business, because there's lots of capital available. But the other thing you need, Tiger, when you start a business is you need human capital. For any venture-backed startup that does well, they're going to be hiring tens of people, hundreds of people, ultimately thousands of people. And, right now, we're in a moment in our society when a lot of people are kind of re-underwriting their career decisions. They're re-underwriting what they want to do with their life. And I think there's going to be more of a swing toward more entrepreneurial activity, people hanging out at bigger institutions. They realize they can work from anywhere. They've been watching here for the last 3 or 4 years, these huge personal fortunes created in entrepreneurial situations. Like it's kind of a pretty strong reinforcing moment for someone who's in their mid-20s to mid-40s to say, I think now's the time to really go for it, because there's lots of capital available. I've really spent the last 15 months in lockdown thinking about what I really want to do with my life. And I don't think it's being at a big employer. So I think there'll be an even greater flow of human talent into the entrepreneurial sector. We already have plenty of money going there. There's always lots of ideas. And there's the pandemic brought a whole bunch of changing ground rules. And when ground rules change, that's a good time for new winners and losers. You know, if everything's status quo, it's harder to have a breakthrough than if all the ground rules are changing. So how can I capitalize on the new ground rule, you know? So I think all of those factors, not just the availability of the capital, bode for interesting days ahead. But I don't think returns are going to stay as high as they are, and that will be a damper.
So it's more of a nuanced situation right now, meaning we will likely see another era of great innovations, but it's not saying that the current valuation level with the current froth are justified per se. So, yeah.
Well, yeah, if you, you know, one of my better investments in my venture career was Intuit. They make TurboTax. They previously made Quicken software. So this is a company that currently has $135 billion market cap. It's a publicly traded company, been public for years. So I was able to buy 6% of that company for about $2.5 million. Okay, now there's a slight time lag here of about that was like 20 years ago. All right,
but still,
but if instead of getting 6% of the company for my $2.5 million, in today, you know, the huge increase in valuation of these things, you know, maybe instead of getting 6%, you get 0.6%. So the company has to be 10 times more successful for you to get the same return you would have gotten. So we can have lots of entrepreneurial success and lots of innovation in our society, but it's all for the investor. It's all about the ratio of the going in price to the going out price.
You know, is it still a good time to be a venture investor? I mean, it seems that the market is becoming more efficient. Returns might be coming down a little bit. So,
yeah, but are they better than the next best thing in your portfolio? You know, I mean, the reason will venture capital continue to beat bonds? You know, probably yes. And again, it's so hard to call the timing because not only are you judging the conditions when you go in, you can see those, hey, it's pretty high valued. You have no visibility on the conditions when you're going to go out of that particular investment that your venture fund makes, you know, because that's 7 years away. Most people don't know what the capital markets are going to be in 7 months, no less 7 years.
I also meant from an individual perspective. I mean, back when you first started, that seems to be the age when not that many people were doing venture capital investing, and that was the time when if you did well, you really shined. But today,
even an idiot, an unbackable idiot like me could make a lot of money.
But today is much harder.
Shooting fish in a barrel. You know, it took. Now venture industry is really hard, but back then it was easy. It was hard to lose money. You know, Tiger, if you look at every institutional venture fund that was formed during the 80s, and by institutional venture fund, I mean more than 10 million of capital, more than half of it coming from people other than the people running the fund. So they made money. Not one of those funds failed to return capital. Then you look at the bond funds of the 80s, when there was the great Asian contagion, you know, this huge write-off of bond, when like a quarter of all bond funds broke the buck and lost money. I mean, it was the world on its head, right? The high-risk thing, venture capital, you almost couldn't lose money.
Became the
low-risk thing. So when the venture industry first started to take off, you really had to be an idiot not to make money. Okay, but that changed. Now it's hard.
I mean, even last year, I feel like when, you know, the Reddit traders, when they're around Robinhood, I mean, my friends who invest in Bitcoin, Tesla are doubling their portfolios in 2 months and 3 months. It seems that everybody's making money. And I want to ask you about this because people portray cryptocurrencies or decentralized finance or Bitcoin, as the next big wave, inefficient market, some kind of, maybe not that high of a bar of entry, but you kind of have to have some knowledge. You have to go in there. So is that the new frontier for investing? We see Andreessen Horowitz just raised a new fund for crypto. I mean, people are stepping in, institutions are stepping in. So what do you think of the space? Is that the new frontier where every fund being raised right now in crypto will all return money?
Yeah, first of all, I'm not a deep crypto investor myself. My colleague at Stanford, Scott Kupor, who you referenced, at Andreessen Horowitz, is a huge hawk on crypto, and Andreessen's raised a couple of funds, and they've attracted very respected investors to those funds. They're not raising it from some offshore family you never heard of. I mean, these are institutions you and I know. And, some of the big crypto investments that have done well are the people who are making the shovels and pickaxes for the crypto industry. It's like the people who made the blue jeans for the gold miners. It didn't matter if they ever hit gold or not. They had to buy blue jeans to go to work. Okay, so a lot of them, the crypto stuff, are people making different structure and different enabling technologies for Bitcoin. Physically holding a Bitcoin itself, has been a very up and down proposition. And in the last 6 or 7 weeks, I'm not sure your buddies who were crowing wildly 5 months ago are still crowing. It's had a lot of cyclicality, and it's still not fully mainstream cryptocurrencies. Time will tell how these are going to be adopted, and there's still a fair amount of skepticism. It's supposed to be this high integrity blockchain, but some of the characters hanging around the Bitcoin world haven't been the most high integrity folks, and some of the things that have occurred haven't been so good. So I think we'll see. Right now, the economic activity last year in the U.S. venture capital, I think crypto was maybe about 6 or 7% of the action. I don't even think it was in double digits. It's still heavily software companies, SaaS. Obviously, last year with the pandemic, life science companies picked up a lot more of the pie than they normally would. And, crypto has its place on the risk frontier for sure. And obviously there's been some great fortunes created already, but it's still a reasonably modest percentage of the overall venture capital risk investment scene.
It seems like you're somewhat hesitant and skeptical of those new phenomena, like SPACs, like the frothy market. But do you feel like you are a techno optimist, or that you hold an inherently optimistic attitudes towards these tech innovations and say that seems to be the future trend, that will be the trend?
Oh, absolutely. And SaaS, I am all in on software as a service. I have no skepticism there. I just, the only thing one needs to be careful of as an investor is the two things that matter: the price you buy and the price you sell, and the time in between. And I'm just saying, if you're coming into a company like Snowflake, okay, at 75 times forward revenue, not forward EBITDA, not forward revenue, that it's kind of priced for perfection, or even more than priced. It's priced for a miracle,
Yes.
And, they would argue, listen, here's what the next 10 years look like. And, it might work out. Google went public at $85 a share. and it's trading at, thousands of dollars a share. And people thought $85 was expensive at the time, but it was pretty consistent with Yahoo's multiple at the time, with other companies. My skepticism around SaaS and other technologies is more skepticism as an investment that one will be able to sell for a lot more than they bought. It's not skepticism about the strength of the underlying technology. It's not skepticism that on-premise enterprise software is dead, that all software is moving to the cloud. I don't have any skepticism about the fundamental essence of the technology. I'm just saying, as a mercenary capitalist, you have to sell for more than you buy. And it's not clear how you're going to do that at the moment.
The price level does matter. It's like saying Bitcoin is the future, but if you bought at 65K at the very top, it will still take you maybe much longer to recover than buying at 30K. I mean, so it will make the world of the difference, or you're just kind of throwing the money away if you're just buying at the top. So Peter, I know we're kind of near the end. Could we maybe run over 10 minutes or something?
Yeah, that's fine, because we had a little break in there. Yeah. Why don't we do 10 more minutes? That's fine.
Yeah.
Thank you.
I wanted to, at the end, ask you some questions about the limitations of the VC funding and its role with the public investments, because you mentioned that you were very bullish on SaaS, but the cynical people would say too much money is going into SaaS, going into these companies that will nevertheless return profits to you within the next 5 to 7 years. But there are innovations such as tackling climate change. There are more foundational technologies that would require a much longer time horizon, 20 years, 30 years, life sciences, biotech, things like that VC funds, private investments are fundamentally unable to capture. So how would you respond to something like that?
Well, venture funds are an economic proposition. That doesn't mean that investments can't be made that have a social overlay and that have social impact. But generally, when a venture capitalist takes money from an endowment or a foundation, then they're a fiduciary of that money, and their job is obviously not to break the law, but to be law-abiding, but to try and grow the money as best as they can to serve the educational purpose of the institution, the philanthropic purpose of the foundation. The venture fund's primary job is not to say, gee, how can I help climate change? And maybe I can make some money while I do that, but maybe I don't. I want to help climate change. That's the foundation's job, to help climate change. But the venture firm's job is to produce a good capital return so that the foundation or the endowment or whoever the end investors in the venture firm can fulfill their mission. Now, there are increasingly some venture funds who say, actually, even if it means we have to get somewhat less return, we're going to focus our capital on things with high social impact, and we're not going to just continually work to have greed overcome fear and fund the 58th SaaS company, or a company in another segment where there's already lots of business activity going on. And that's for the investors to decide if they want to invest in funds like that. But for most social funders in our country, most foundations, most wealthy families, they want to grow their capital in a way that isn't counterproductive for the social things, but they're generally not trying to grow their capital in a way that absolutely maximizes the programmatic outcomes. They want to maximize the financial outcomes, take the financial gain, and then the family involved or the foundation will direct that to the social purposes. So it's not exactly church and state, but there are kind of two different things going on there. And if you try to jumble them all together, you have to be careful when you do that.
It does
Does
seem
that
very
make sense?
difficult. Yes, that absolutely makes sense, because you have a different mandate. Your mandate is not to
Yeah.
produce social good per se. But when you look at, another investment, another SaaS company or another consumer goods, another social media, do you feel that sometimes that there's a little bit of access that had we devoted, there are other efficient frontiers, risky frontiers that could be invested in, pockets?
Well, I'm kind of an old-fashioned guy who thinks the economy will largely sort that out. If we have one too many SaaS companies, you know what? It's not going to do well. If it's the, if it's the fifth entrant into a space, doing SaaS software for pet stores, let's say.
Yeah,
Okay,
yeah.
and this is now the fifth company that's trying to have a SaaS program to run your pet store. But there's only so many pet stores in America. Most of them are online anyway by now. When fields get overcrowded, economics take over. 1,000,000 years ago, before you were born, and the floppy disk drive industry was here at the beginning of the IT revolution in the late 70s and early 80s, 41 floppy disk drive companies got funded by venture capitalists. 5 of them made money, right? And each venture capitalist, they had a smart guy like Tiger Gao analyzing, running the numbers, but they weren't thinking in the total sense of the market, right? They were making individual decisions about individual companies. And that's a little what's going on now. You can develop a case for why the next SaaS company is going to be great, but every venture firm is doing the same thing, and they're all going to collide on the market at once. So, but economics take care of that. You don't need a scolding. Economics will scold you.
Peter, I guess since we're on this topic about social value, maybe my ending question for this section would be: do you think Silicon Valley has, either at this current stage or over the past 30, 40 years, yielded overall net positive impacts on a society? Because, for example, people say it's very hard to say Facebook is a net positive impact on the society. It's very hard to, So, what do you think of that question? And do you think technology a lot of times cannot solve the problem that technology creates?
Well, as for the first part of your question, I think absolutely the country and the world are better places because of the innovation brought forward over the last couple of decades by technology companies. Does that mean everything venture capitalists ever funded is for a greater purpose? No, but look at Apple Computer. Okay, is the world a better place because we have smartphones? Okay, is the world a better place because we have iPads? And in the life science, look at Moderna. Okay, Moderna was a heavy venture capital. I got the Moderna vaccine. Hey, that's pretty good.
We had Moderna's co-founder Robert Langer on the show a few months ago.
Yeah, how could, and again, if venture capitalists fund at least several thousand new companies a year, a lot of them don't amount to much anyway. Some of them are going to be controversial in what they bring forward, but again, we live in an economic world. If Facebook is such a bad thing, how come so many people in your generation are hanging out on it? It can't be rat poison, or we would have lost a whole generation of people. So by and large, innovation, since the earliest days of society, innovation has always been what moved things forward, and it's not going to be perfect. And sometimes government's going to have to step in and control things at the edges. That happened at the time of the big oil monopolies. It happened at the time of the big telecommunications monopolies. There's got to be limits on innovation, and government's role is to make the trade-offs between innovation and greater good. That's why we elect men and women to government to decide those things. But the innovators are never going to be totally self-policing. They're going to innovate.
So Peter, since we're talking about future trends, I'll just end the interview on some maybe quick fire questions
Certainly.
to get your thoughts on certain sectors. What are some of the most promising sectors and trends on your mind for the next 10, 20 years, 30 years?
Yeah, I think while we've made a lot of progress in artificial intelligence, in computers, teaching computers, I think we're at the early days of that. And I think that's something in 5 or 10 years, that's going to bump up against a lot of regulation of saying, wait a minute, how can you have a computer deciding this and no humans and blah, blah, blah. You know, they'll be, you watch. that will, the power of AI will become a regulatory issue if it keeps increasing exponentially as it has. I think, you know, 4 or 5 years ago, it was fashionable to talk about the Internet of Things. And that's kind of not a big thing in the news anymore. But, you know, everything is getting automated. There won't be, I mean, obviously your doorbell, your door lock, your oven, your everything is online, but it's still the interconnectivity of modern life still has a way to go. Okay. I mean, it will be so different, Tiger, for your children, how automated their life is physically compared to what it is today. And there will be opportunities in that. And particularly in the developing world, which isn't so automated now, they'll just skip a generation of things. Look at, I work a lot with India now. And, you know, India never had plain old telephone service. You know, India went from having no communication to everyone on cell phones. They just skipped a whole generation of technology. And as the world becomes more automated, I think you'll see things like that where backward nations can suddenly adopt technologies that will be so cheap that will bring them into the modern world, and they won't have gone through 1 or 2 generations of outmoded technology. So I think there'll be, and automation also has to do with robotics and what gets done physically by people and what can get done by machines, particularly AI-powered machines. So it's, your kids are going to have a great world, Tiger.
Does that mean you're bullish on augmented reality, virtual reality, AR, VR, these things?
Yes, the short answer would be yes. You know, I never had a lot of involvement with augmented reality until over the last year at this Indian firm that I support, Westbridge Capital. We have a global meeting every year. We couldn't have a global meeting this year. So we sent out Oculus headsets to the 110 investors, and we did a walking tour of India that we put in 3D, and it was like they were there. We had a great investment year at Westbridge, but they were more impressed with the virtual reality explaining what we were doing in the places we were involved with. It was very powerful. You know, it's fighting a price curve. You know, Oculus has an offering out now at $199, but when it's $25, that technology really start to move.
So the guy that made Oculus, Palmer Luckey, founded Anduril, which is a military tech company. What are your thoughts on military tech? Palantir, Anduril, these things, hardware.
Facial recognition. I mean, you put a lot of, you know, kind of third rail stuff in there. There's generally a place for these things with the proper constraints. And the political debate is, what are the proper constraints? You know, if facial recognition could help you catch horrible criminals and rapists and thugs, that no one would question it. But what constraints do you put around military technology? What constraints do you put around policing technology? These are not things that you should let the free market figure out. Those are things where you're going to have some level of government intervention to establish appropriate boundaries, and everyone won't agree on the boundaries. That's why you have elected officials. That's why you have democracy.
So we're currently doing this thing called podcasting, which didn't exist many years ago, but nowadays it seems that Silicon Valley are all on Clubhouse. Have you heard about Clubhouse, and are you on Clubhouse?
Oh, yeah, but it's so old-fashioned, Tiger. It's just audio. I mean, it's like, God, like, oh, gee, I think I'll call my buddies, but that's it's slickly packaged. Andreessen is a big funder of that. Mark and Ben go on there, do their things, but
every day.
The experience is not exactly an out-of-body experience. I mean, it's like talking to people.
Is this the future? So it's not the future in some way.
Well, I don't know. We'll see what Clubhouse begets, but I'm not sure there's a whole generation of interesting things coming from that.
Last two questions. The first one, what would be one contrarian view that you hold that many other VC people might disagree with? Anything contrarian from you?
Yeah, I think the VC industry can vastly expand the opportunity set of people who participate as venture capitalists, people to whom venture capital is given. Both of those groups don't look much like America today. And I think they can become much more like America, and returns will even get better. I don't think there's an economic cost of doing that. But right now, venture capital is still a quite exclusive club. And particularly older venture capitalists have different views of how much the industry can be democratized. But I'm an optimist who I think in the next 10 years, a lot of new participants can come into the venture industry, and a lot of new participants can receive venture capital that demographically don't look like those at the party at the moment.
The name of our show is Policy Punchline. So last question at the end, in our tradition, what would your punchline be for this interview, for the VC community, for your career? What's the punchline? Well, I think the punchline is that opportunity and innovation are unstoppable, that as a society and as an industry, we need to find ways to make sure everyone is participating in that, not just certain demographics. And as a society, we have to understand that sometimes innovation will go right up to the boundaries. That's what innovation is supposed to do, and will even go past the boundaries. So therefore, societal forces are going to have to rein things in like they're doing now. It'll be a great political debate. It'll be a great coming decades. You're lucky to be young. I wish I were around for it. Thank you very much, Peter. I was betting on whether your punchline would be Bitcoin to the moon. It's not. So. No, don't. I'd be more involved in a round trip, and I'm not sure Bitcoin will get you back. Thank you so much for this wonderful conversation today, and telling us so much. How can people follow you? Are you on Twitter? Do you write often anywhere? The truth be known, I live under a rock. Okay, I rarely, we're not that you're such a distinguished guy, Tiger, I wouldn't do this. I'm not on Twitter. I'm not on Facebook. I'm nowhere. I teach my 80 students a year at Stanford, and I manage my financial affairs. My wife and I have 6 kids. I manage my family. We have grandchildren, and life has worked out great, and I can provide
for all that, and that's where my focus is. So I don't hang out on social media.
Now that you're on podcast, that's all enough.
Yeah.
So thank you so much, Peter, and we'll definitely encourage our listeners to seek you out, to follow your investment, follow your work, and encourage them to learn more about all these trends that you talked about. So thank you so much for listening today. That concludes this episode of Policy Punchline. You may watch this video on YouTube, listen on iTunes, Spotify, SoundCloud, your preferred podcasting platform. You can rate and review us. We'll see you next time. You've been listening to Policy Punchline, a podcast generously supported by the Julius Rabinowitz Center for Public Policy and Finance at Princeton University. We would also like to encourage you to follow other podcasts produced by Princeton University, such as Politics and Polls by the Woodrow Wilson School of Public and International Affairs. Policy Punchline is intended to be informational only and does not reflect nor represent the views of Princeton University or the Julius Rabinowitz Center for Public Policy and Finance. For more information on subscription, donation, volunteering, or contact, please visit policypunchline.com. Thank you again for listening.